All right, so we had this parabolic drop this morning. Low, lower low. Rallied. What is this? What's that right there? Fair value gap. Buy side imbalance, sell side inefficiency, because it's an up closed candle. Ideally, what do you want to see? You want to see a piece left open. Did it fully close in that? No. Where did it trade to? The lower quadrant. You see that? Right there? Where's the bodies? See that? And then once it did that, what does it reach for? Premium. Premium relative to what? You have this range here, and then you have the larger range there. See that? I'm not going to refer back to this here because we've already had what happened. That's your range of the day. Did we go above equilibrium? Yes, multiple times in closing basis. So you can't use that range now for defining short-term premium and discount. This low did not take that low out, but we had market trade higher. So we have to look at a shorter time frame range, which is inside the larger range of the day. So from this low to that high, above this level, we have to look for inefficiencies when we're retracing. Is there inefficiency in here? No. And then you have the short-term high, and you have this high here. Any inefficiencies over here? Not on this time frame. So that's using this range here. If you're using the even smaller time frame, shorter term range here, this is all trading inside the range, needing not to see it trade outside the range. It rallies here, your fair value gap there. See that? Where did I tell you the ideal entries are going to be at? If you're trading fair value gaps or bullish order blocks that are buys or bullish, it's going to be in the upper half. So there's your fair value gap. There's the high of it. Here's consequent encroachment. Oh, hot damn, look at that. This seems to keep happening over and over and over again. So we have relative equal highs here, and then we have this wick. See how we've already worked consequent encroachment that multiple times in here? Because it's done that and it's rallying, I would want to see that buy side above the wick's high now, and then maybe revisit this inefficiency because it left a small little piece open right there. I'll draw that out. It's a rectangle. So for PM session consideration, if we continue to press higher, just look for it to trade into that. And then we have this inefficiency over here that was left open. And we'll do this. See how we went to consequent encroachment, that inefficiency there? Overshot a little bit, but look at the bodies. Then we had a breakdown. Shift in market structure. This model 2022. Where's the sell side? There. That's what it hit. Over here, I get so many questions for like where do you place your stop loss at? If I'm trading with a fair value gap, I'm putting it below the candle or above the candle relative to if I'm buying or selling the candle that creates the gap. That's what I'm doing. If I get stopped out and it trades back below or above respective to the fair value gap in deference to it being a bullish or bearish PD array, I'll treat it as it needs to move out of it and then come back and retest it. And then if it does, then I'll enter there and I'll put the same stop loss I used initially. So looking for setups like something like this one here, okay? If you were to take that long and only use the low of that candlestick right there, if you were only going to use a simple bread and butter approach to just trying to make money, you're literally just trying to get money and get done and move to the sidelines and go live your life. You could use this pattern here, and the range that it is retraced from, that's this high right here. Be honest, okay? If you were able to find setups like this on a daily basis, buying inside of a fair value gap, the easiest sure thing entry, which is the only one that I think you should be worrying about right now, one tick below the low of the candle that creates the highest parameter for the fair value gap. Because if this is the fair value gap, let me zoom in just to be this candle here, okay? This is the fair value gap between this candle's high and that candle's low. This frames where your stop loss is. So your stop loss has to be at the body or the low. Depends on what you're willing to assume in terms of risk. If you want to be really aggressive about risk, you're doing trade with a larger leverage, then you're going to obviously go with the body. If you're more risk averse and you're not going to trade with large leverage and you're learning still and you want to give yourself some flexibility to stay in the trade and not be potentially stopped out, you're going to use the low of that candlestick. But the entry would be one tick below that. That's the easiest, no-brainer. This is how you do it. The stop loss is the low. Or if you are using larger leverage and your convictions are strong, you can use the body's low. In this case, it would be opening price. So the difference is whatever that is. How many contracts can you trade? I don't know what you're trading with in terms of equity, but you should be trading the least leverage that you can possibly do. That's a micro. A micro, okay? You're not risking a whole lot of anything, but you're learning. And then you just target the buy side here. So the buy side, remember I was telling you over here, that wick and how we already went to consequent encroachment of that wick multiple times. That means we have to cancel that as a draw. It can't act as a draw anymore. It's not something we would favor. It's the high of that candle. That would be the one that would be the buy side. That would be the draw. So you can see how we ran up in there and engaged that liquidity. So if it's going to move above that, how far can it go? That's a question I get all the time. Like if you're looking for a high to be traded to, how far can it go? How can you trust when I do turtle soups, when I try to sell old highs being broke and pierced, and I sell short as it's running through them? They're going to be instances where like it's an obvious PD array above a buy side that I trust is the final definitive target that they're aiming for repricing it to a deep premium before sinking it to a discount. In that case, or in this case here, the buy side resting above that wick, just above it, well, how far can it go? Well, then you have this inefficiency. We've already traded to it, but see the difference between the high? Look at the high right there. That's this price up here. The high of that candlestick is 17,908.50. And then the low of that candle over here is one tick. That's enough for the market to want to reprice up there because it's a separation. It's a separation between this candle's low and this candle's high. So it's a SIBI there, sell side imbalance, buy side inefficiency. So how far can I and would I measure if it's going to go above it on high? It's this entire range. It doesn't need to do that, but that's what you aim for, and you trade it accordingly. So if you were long, say you took off, say you had 2 contracts, and you went long down here. You take one off here, and you let it run. The target was explained to you over here. That's the buy side, and you want to sit back and wait for it to engage that. Then you have a choice. You either take it off on a limit at that level, or hold it and manage a stop loss to see if it can dig up into here and maybe even run off even higher. That's the purpose and the luxury of having a runner. You have the luxury of determining what you want to do with it. Do you want to cut it off at a definitive level? Well, I gave you that. It's right above here. If you want to let it run, if it gets to that point, how can you manage that? You use it as a trailing stop loss. Trailing stop losses prior to areas where a partial would be logical. If you're trading any position with a trailing stop loss and you're moving it up into a range from a discount and then you're entering the realm of what would be premium, and I'll explain that to you right now. In this example, you would have this. That high to that low is what we measured, and we would be in a discount still trading to this fair value gap, which is the first one that formed because there's no fair value gap in any of these up close candles. The market trades down into that fair value gap. That's your first entry that you can now target premium. Premium is defined by the high to low of that range. So midpoint of that, let me just pop it up real quick. That's equilibrium. So minimum is to trade to that, but it does that and then it comes back to that fair value gap. So now we're in a discount because here's equilibrium to the low. Discount. Then it's going to do what? It's going to expand up into a premium. So what premium arrays do we have? This high, relative equal highs, that wick I talked about, and I said that high. How far can it go above that? It can go up into this old range and bump that last up close candle. You either take it off there on a hard line limit to say, okay, my final runner, we're just going to call it a day there and be content with it. Or how would you manage the stop loss? Your stop loss cannot enter above this region here because you're entering into a realm where it can retrace still. So your stop loss has to be, oh, this will be a good place here. So whatever it was here, it's trailed up to there. If you look at my trades, that's how I'm managing them. Unless I'm real close to terminus and I have one like contract left, then I'll trail it up to something that would be below here because there's a fair value gap and we already traded to it. So I wouldn't want to see that fair value gap traded to and go over, or below it rather. It would be failed. Okay. So it's a matter of context, where you are in the trade relative to where you were targeting. And the runner is where you want to finesse. The last little piece of your profitable trade, that's the one that you have the luxury to finesse. Whether you get stopped out on it, whether it goes to a hardline limit order and you exit out there, or you hold on to it and you keep your stop loss at break even plus commissions and costs and just let it rip and go see what happens. None of those outcomes are wrong. Because if you take it off at any time and it runs 200 handles, and if you would have stayed in it with that runner, you're going to consider that wrong. You're going to beat yourself up about it. So you got to give yourself permission that any outcome on a runner in a profitable trade after you've banked partials, there's nothing wrong with anything that you do with it. There's nothing wrong with that. And that's managing your expectations. It's also managing your ability to stay within the context of a bias, whether it be the daily bias or the session bias.